Tom, let's go to a chart which shows so much of what you predicted was it didn't happen. This is the ECI measurement, which is a comprehensive measurement, and I've adjusted it for 3% inflation. I arbitrarily picked it, and maybe it's an inflation, Tom Porcelli, that America feels, even if it's a little less inflation. This just, it didn't happen, and it's great, but it's barely great. Do we get beyond barely in the coming year?
Yeah, we do, actually. In fact, we just wrote about this in our daily, the thing I just forwarded to you. And, if you look at our wage model, which leads ECI, over the coming year, you're easily near 3.5% from a run rate
And we get tangible wage growth like we had in 2005.
Yeah, I mean, look, I would actually tell you that the wage growth is tangible now. It's sort of, and as we said right before the break, it's across the board. It's not just funneling to the upper income. It's actually literally going more now to the lower income buckets, lower income jobs. So, yeah, I would say that this chart is just going to continue to rise. It's a sort of a high conviction call from our perspective.
Tom, how many hikes are you expecting from the Fed next year?
Yeah, so we obviously we're expecting a hike in December, and then we're actually looking for 4 hikes next year. Yeah, and look, I don't know if this is the segment that you guys want to talk about this on, but what I would what I would say is there's a couple of things here. One, I think what we have to keep in mind is that if you look at the Fed's estimate for growth in particular, what you're looking at is 3.1% for this year. That's their GDP estimate. 2.5% for next year, so 0.6% slowing in growth, which is not immaterial. And what's interesting about that is they expect that this slowing is on the back of fiscal stimulus coming off the boil. And one of the things that we've been trying to show recently is if you actually look at savings, right, the savings from the tax cuts, what our work shows is that most of that savings has actually been saved. So people actually haven't been really using this in earnest at all. And that's compelling, right? So if the Fed is actually baking in a slowing in growth, and it doesn't materialize next year, which, again, we would say is highly likely, then, I think they're going to feel really comfortable with their 3, almost 4 hikes next year, and that's our call.
Right,
and by the way, that's just one key factor.
So
there's another one that sort of drives that idea, which I'm sure we'll get into over the next hour, but I think that's one important notion to keep in mind.
Yeah, so Tom, you're basically pushing back. There are a lot of people that come on the program and say, look, they're worried about 2020 because there's going to be a confluence of a slowing economy worldwide, together with the end of the tax cuts, which could push the U.S. in, if not a recession, a significant slowdown. You're pushing back against that. Yeah,
I mean, again, I think that a lot of the sort of slowdown that people expect is all on the back of this fiscal idea, right? This notion that fiscal stimulus has basically been sort of used up this year. You're not going to really see much for next year. And again, I think the evidence is quite clear that you actually haven't really seen much of it.